Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the idea of a portable mortgage, also the big beat on purchase apps, and Bostic leaving the Fed. Before we get started, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Wow, what a day. Man, a lot has happened this morning, so we have a lot to talk about.
We do. Let's start with the purchase apps, because that surprised a lot of people. Didn't really surprise you.
No, I mean, one of the things we talked about recently is that we're going to have some really, really low comps coming up in the next few weeks because last year at this time, mortgage rates shot up to above 7%, and then it impacts some of the data lines, of course. But this was one of the best purchase application data prints we've had in years because it's not so much of the 31% year-over-year growth. Whenever you're running 30% year-over-year growth plus, you're running. It's like Christian McCaffrey, on that toss sweep he gets, and he's got good block and he's gone, right? You're going to get a good play. You can have 5 to 12% year-over-year growth in purchase apps that have nothing happening with sales. It would just be flat or maybe slightly higher. You really want to see double-digit year-over-year growth with weekly growth to go in it. But when you're running 31%, that's material. I mean, when the COVID-19 recovery was happening, and I brought up the theory that existing home sales are going to be positive, everybody's like, there's no way existing home sales are going to be positive. It's like we're running 35% positive data lines now. So we are good. In that context, I think that was shocking. But to me, the best part was the week-to-week data. 6% week-to-week, 30%. You can run a lot of stuff with those kind of data lines. So a positive, this happened a little bit with a little bit higher rates recently. So a good report. And again, we want to see at least 12 to 14 weeks of positive weekly data. This makes it 9, right? And we've had these little runs in late 2022, mid 2024, and now we're having one again. So we got 3 or 5 more weeks to go. We've talked about this recently that, Thanksgiving, December, maybe we could get to there as long as rates stay near 6%. The whole key is getting rates to stay near 6% with duration.
That is good news. And it echoes what you wrote in the tracker this last week that, we're seeing demand up a little bit, not huge, but up a little bit. And that's great at this time of year.
Well, it is the other aspect about purchase apps, because I think purchase apps is very confusing because some of our better sales data reports that we've had in the last 3 years, we had no year-over-year growth in purchase apps, but the weekly data's got better. But here, weekly data, positive year-over-year, you could get something working there. Of course, the weekly pending contracts data of ours showed 15% year-over-year growth. Again, a little bit of a low comp because rates rose, but you could get something working here, right? And this is the whole thing. All this talk about 50-year mortgages, portable mortgages, just getting rates down to 6. You don't need 3, you don't need 4, you don't need 5, but just you could get something moving out there. Maybe that'll alleviate the public, angst and, policy angst of trying to get things moving. Because, I had this good discussion this morning with a Wall Street trader that if you look at the new home sales market, it's 2019 levels. It's pre-COVID. That would equate to 1 to 1.2 million more existing home sales. But that marketplace is running between 4.75 to 5.75 mortgage rates. So you don't have that in the existing home sales report. So you could just get rates a little bit lower, how low existing home sales are. You could get a little bit of kick. And we take it from there, right? The housing dynamic shifted here in mid-June. So it's positive that we're seeing this now because this looks out 30, 60, 90 days. And you want to keep that momentum because what we've seen in the last few years is that the seasonal demand curve in purchase apps are starting earlier, right? November, December in the last few years. We tested that last year with rates being elevated and the year-over-year data was still holding up. But it used to be the second week of January to the first week of May after May total volume. So maybe part of this is the seasonal curve, but again, all of this net positive. Housing isn't booming or any of that stuff, but we're seeing a positive demand curve with rates getting just near 6%, which has been our theme for for a very, very long time. And it's good to see it now for the third time. The model works.
We will take that positive news. Let's talk about, you mentioned portable mortgages. So this is the latest thing. Obviously, Trump has gotten a ton of pushback. Pulte's gotten a ton of pushback on the 50-year mortgage idea. Here's another thing they're talking about. And, on the positive side, it's nice to have conversations about like what could get mortgage going, what could get home buying going. Portable mortgage, how do you feel about that? And, is this a potential winner compared to the 50-year mortgage?
If I had to choose between a 50 and a portable, first of all, if I had to choose at all, I wouldn't do any of these. But clearly, they're hearing it from homeowners and people that this is the aspect that the Federal Reserve still hasn't realized. They're academics, so they look at economics as numbers, but housing is what we always said: sex, marriage, babies, moving, life. Right? Life finds a way. When you have the third calendar year of the lowest home sales ever, right? And then all of a sudden, when people see demand pick up a little bit, when rates go lower and then rates go up, people start to get a little bit more chippy. And we talked about this early or late 2024 that, we might see some policy changes just because, people want to get things going again, because it's a function of how we live in this country. Portable mortgages have some logistic issues in terms, kind of like assumable mortgages, where you have to get the difference of the loan and you have to make sure you qualify. But you still have 70% of the country that has rates 5% and under. So the theory is that if you can move that, it does make the cost. Like, imagine just hypothetically, everyone just put down your bias out of the equation. What if mortgage rates were at 5% now for 1 year? Do we think demand gets worse, or do we think the demand gets better?
Demand gets much better.
Yeah, I mean, demand will get better. I mean, we see it getting better. We're near 6. So if you have 70% of the marketplace at 5% and under, so we'll see. I mean, obviously there was a big backlash to the 50-year mortgage. But portable mortgages seem to be a little bit more, people are a little bit more open to the idea out there. I mean, me personally, I wouldn't change a thing, but that's me and I'm not making the choices. But if I had to choose between them both, that would be it.
Well, let's talk about what a portable mortgage is, because there might be listeners to this podcast that's like, I'm not exactly sure what that is. Is that you take your same loan and you move to another house? Like, can you explain exactly what that is?
I mean, just to keep it as simple, because there's so many different components into it and there's different forms of portable mortgages. You basically kind of take the rate and you kind of reapply for this house that you want to move to, and you keep the rate, but you got to qualify for the loan. If there's a difference between the loan balance, you got to bring that money in. So sometimes you got to bring a second. If the loan balance is under, you got to, it's kind of like an assumable mortgage, but you're just basically taking your current rate and you're moving it to the next property. So it has to be, a convergence of, I'm taking this, here I go, I move it. Usually you have a 30 to 120 day grace period to make that transaction work in terms of, for a bank, it would be perfect if you do it all the same day, and you just it's what it sounds like. You just take the mortgage and move it over here and you take the rate. So because you have so many people in the country with, I mean, it goes into the mortgage rate lockdown discussion, which that's a whole different topic, but people have always been selling their low mortgage rates to buy. But I think what the White House is saying is that more people will sell their homes and move if we can move that mortgage rate over out there. So that's in the simplest way. Just think of it as that, because there's all these other different variables that go into it and procedures that might confuse people. But clearly the 50-year trial balloon didn't work. So let's just try portable and assumable mortgages and go with that.
How does industry feel about this? How do loan officers, would they be like, yay, portable mortgages? Is that good for our industry?
This is where the logistics of, you have to find the details of what they want. If you have to reapply for a mortgage and just transfer the rate, you have to basically do the loan over again. And that can be a transaction. The banks might not like this as much, but it's one of the it's a very confusing topic because we do have this assumable loan discussion, and the assumable loans aren't getting any traction, right? Because you got to get a seller that wants to buy that house, and then
Right.
that person takes it, and then that person has to do something with the property, and then you have to get a second mortgage, and it takes too long. So here I hate all of these ideas. I'm sitting here. I have to talk about them, but I hate the 50-year mortgage and I hate the portable mortgage. We have a functioning system. It's just that the Fed has kept policy too restrictive for housing, but we have to talk about this. So, if you can get a transaction off of a portable mortgage that a loan officer can do, then you have something there. If for some reason there is no transaction allowed in this process, then it's basically, the servicer is basically going to be the processor. So that means you do not have a loan out there. So that'll be less transaction volumes, but it really depends on how they want to format that. This is why I don't want to confuse people, because I could already see people saying, oh my God, there's going to be a lot less transactions. This is really bad for loan officers. And then some people go, well, loan officers have to do this again. So this is the thing about trial balloons. You can take a lot of things. I urge and caution everyone, do not put much weight into any of these things until you see the legal ramifications of what they're going to do and how the process works. So I've already seen very extreme takes on this. They're going to say volumes have to go down for loan officers. But that's the gist of it in terms of some of the talking points today. But I know for a fact that you do have to reapply for a new mortgage. You can't just take your 5% and move it here, because what if you bought a house that was X amount? You have to bring money into the loans. You have to balance it out. You have to qualify for it. Does the qualified mortgage laws go into portable mortgage? There's all these things that these are trial balloons. They're throwing up in the air. Do not put much weight into any of them until you see legal action taken, signed, and delivered. For now, and maybe for a while, we just have our simple, boring 30-year mortgage and ARM products that have been a functioning process of housing. This is why part of me hates this conversation, but part of me says I have to have this, because this is where we're at right now. When housing demand stays low for a very long time and you don't get any traction, people get angry. And when people get angry, voters get angry. Voters cause constantly, and everybody's trying to do anything. We're talking about getting rid of property taxes. We're talking about portable mortgages. This is all because people are mad. So it is what it is, but this is the world we live in.
Okay, well, let's get to your a better topic for you, because you just said, really, we just need the Fed to do what they want to do. We had the announcement, Bostic today announced his resignation. He is he a voting member?
Bostic was somebody we talked about months ago, and I said he's cooked. Boston is the next to go. He's not resigning in a sense like he's resigning today. He's retiring. So okay. Bostic was one of these, he used to be a dove and he became kind of hawkish. So just to keep it simple, he's finished. It's over. He does have, he'll be part of the process up until February, but we're already nominating Neil Dutta to replace Bostic, at the Atlanta Fed out there. And another positive outcome for the housing market, because Bostic came out today and said, I don't want to lower rates at all until we get to 2% inflation. And I just retweeted that and did the old nah, hey, goodbye. Thank you for your service, Bostic. Move along. So this was in the works a while ago, but I was almost running out of time for the call of the year. But yeah, he was next on the list to go bye-bye. Positive outcome for housing.
Okay, so that does seem, I was going to say that's the bottom line, positive outcome for housing. Let's talk about where mortgage rates are, 10-year yield is amid all these other things happening.
Well, the interesting aspect of yesterday is, of course, the bond market goes, by the way, to the gentleman who called me and said, why is the bond market so stable? Okay, no. Holidays, stock market can be open and the bond market won't be. In any case, the ADP reports, the weekly curves are, or the ADP is now provided week-to-week data, and their jobs data showed a significant decline. And then Goldman Sachs came out yesterday and says the October payrolls are down 50,000. Beth Hammock, paging Beth Hammock right now. Oh, Beth Hammock is going, everything's wonderful, great. There's nothing wrong with the labor market. Because of that, bond yields, when evening trading came, they just fell right away. And this morning, I think the last time I saw it was 406. So again, paper, rock, scissors, labor over inflation, right? The only reason mortgage rates are down here, labor data got softer because if it was up to the Fed, mortgage rates will still be elevated. Number two, the mortgage spreads, of course, hug a spread. All of you get to see that chart that I put up there, especially on the weekend tracker. It's made now a significant move on a year-over-year basis. So we wouldn't even be here near 6% if it wasn't for the spreads or the labor data. So this is why it's a kind of a blessing in disguise. Labor data got softer and spreads got better because the 10-year yield never got down toward 362 like it did last year. We wouldn't have rates this low if the spreads didn't improve.
So we're recording this on Wednesday. Of course, the shutdown is winding down, but it's still in effect right now. And we talked about how it might be a while before we get that jobs data. But with that kind of jobs data that we got from other sources, I mean, were you surprised? Did you think we'd go down even more, or how did you interpret that job data?
I honestly don't think the Fed cares until jobless claims breaks. I've been saying this. See, it is interesting that our premise since 2022 was that they will wait until the labor market breaks before they start getting dovish. They are sitting here today saying they are modestly restrictive, and they're now finally admitting that the labor data is deteriorating, but they still are saying they're modestly restrictive. Why? They need the damn thing to break before they turn. They have stayed consistent. And again, now part of the thing with, one of the things I try to explain to people is that the Fed has already told us we're not going to take any of the labor data seriously during the shutdown because, it could be hit and then we'll just rebound. So they will throw everything they can to keep policy as restrictive as possible because that's what they told everyone late 2022. At least that's how I interpret it. So it is not shocking. We're just the same little trend, but you're probably going to have to wait for the rebound in after the post shutdown data for the Fed to maybe take it a little bit more seriously. Now, this is not all the Fed members. There's the Civil War. There's a lot of Fed people that are saying, hey, listen, there is demand destruction and it's impacting the data lines. We are basically little job growth, a little firings. We are very prone to maybe some type of shock. So the Civil War is good. Makes the December meeting good. But again, to me, it's always been about jobless claims because the Federal Reserve did their own jobless claims analysis this year that they shared out with people. Now they would say, well, when jobless claims gets to 400,000, then the labor market is, no, it's a rate of change. It has to have a first level break before, you get to those levels. So not surprising, but again, does this part of the Fed really care? Because I know this part of the Fed does, but this part of the Fed doesn't, not until yet. So we are slowly moving down to neutral. We are modestly restrictive. When they use that sentence, we no longer want to be modestly restrictive. We would like to get to neutral policy as fast as possible. And then if we need to go accommodative, that's the ball game switch. When they start saying that, but they didn't. Remember Powell, we said, rates are near 6%. He's going to freak out. So what did Powell do? Hey, wait a second. Everything's great. This is an emergency cut. This is insurance cuts. This is whatever it is. They are basically acting as predictable people or characters in a play. So, but that explains why bond yields. A lot of people are like, why are bond yields falling? The labor data, like what labor data? And you show them the ADP report, Goldman Sachs headline. So, again, just imagine that if we didn't see weakness in the data and we didn't have the spreads improve, we're still near 7%. So that's the modestly restrictive Federal Reserve policy. That's why housing permits have been in recession for years. That's why housing starts have been in recession for years. We're losing residential construction jobs, specialty contractor trade jobs are being lost. And they're asking, I wonder if there's any real demand destruction. Where do you get these people? It's literally there in the monthly reports for 2 years. Come on now. So, but the unfortunate reality is that the Fed doesn't make its policy around housing. It makes a policy on their dual mandate. That's why labor is very important. So the growth rate of inflation is picking up. I think some of the Fed is surprised that it didn't pick up higher, but they're near their targets for 2025, but their labor data got worse than they thought.
If you were giving a forecast of do we get a rate cut in December, where are we right now?
I would say rate cut, because you can't have this kind of deterioration. I know Daryl Fairweather, who's the economist for Redfin, she sits on the Dallas Fed board, and she was talking about that the Fed doesn't have a lot of data to make a decision. Yes, you do. You do have a lot of data. If all the data miners in the world are looking at aggregate data and it's not looking good, then you have to tell the public right now, we want to put a little bit more weight on inflation. So don't, this is why I'm in the December rate cut camp, because let's just say if the labor data started getting better. Let's say Revlio's data was positive, ADP was positive, Goldman Sachs said we had 50,000 plus jobs created. Then that's a different variable, because those are things that we're all using as data miners. If the Federal Reserve is not using them, then all of them should be fired. But there's enough stuff out there. It's their choice, right? It's a policy choice. So you have the Hawks, you have the Doves, the Civil War, Iron Man versus Captain America. There you go. That kind of stuff is happening. So December is up and live, but I think that the labor data shocked some people yesterday out there, and you now have a string of data lines: Revlio, ADP, and then Goldman's estimates of payrolls. It's really hard to say to people, we still want to be modestly restrictive in that environment. If the labor data got better, hey, listen, I would tell you that rates are going to go up, right? Rates are going to go up. The only reason we're here. So I would say December cut in. But again, the bond market is, the closer you are to 4% on the 10-year yield, the bond market is pricing in a lot of rate cuts. So just kind of keep it at that. It's really hard to get below 380 on the 10-year yield with modestly restrictive or neutral policy. This is why we kind of hold the line right there. Last year, obviously it broke, but last year everyone was bent on the recession. That didn't happen.
Incredible. Thank you so much for walking us through all of the things that are going on right now. Logan, we will talk to you again soon.
Pleasure.